Assalamualaikum and salam sejahtera. My name is MARIYAH NATASYA binti ZAKARIA 228637 from ACN3101 Accounting and Information. Today, our group will present about health check and also tax accounting. So, the objective our presentation today is to analyze the financial performance of Serdang Shine Car Wash to evaluate profitability, liquidity and also solvency, and to recommend whether the business should take a 50,000 loan or not, and also to explain the important things of tax accounting. Alright, for the next part, I will explain a little bit company background about Serdang Shine Car Wash. Serdang Shine Car Wash is a small business providing professional car washing and detailing service. The financial health check evaluates whether the business is financially strong enough for expansions. Our purpose of financial health check, which is measure financial performance, identify strength of weakness, support business decision making, and also evaluate ability to repay future loans. Alright, now to calculate profitability ratios. The formula is gross profit divided by revenue times 100. So the calculation is 150,000 divided by 250,000 times 100 equals to 60%. So which is the strong control over the direct cost, right? So the company will earn 60 cents gross profit for every 1 ringgit of sales.
We have net profit margin. So the formula is net profit divided to revenue times to 100. So the calculation is 65,000 divided to 250,000 times 100. So the result is 26%. So this shows strong profitability. After all, expenses improve efficient cost management. We have net profit margin. So the formula is net profit divided to revenue times to 100. So the calculation is 65,000 divided to 250,000 times 100. So the result is 26%. So this shows strong profitability. After all, expenses improve efficient cost management. We have net profit margin. So the formula is net profit divided to revenue times to 100. So the calculation is 65,000 divided to 250,000 times 100. So the result is 26%. So this shows strong profitability. After all, expenses improve efficient cost management. We have net profit margin. So the formula is net profit divided to revenue times to 100. So the calculation is 65,000 divided to 250,000 times 100. So the result is 26%. So this shows strong profitability. After all, expenses improve efficient cost management. We have net profit margin. So the formula is net profit divided to revenue times to 100. So the calculation is 65,000 divided to 250,000 times 100. So the result is 26%. So this shows strong profitability. After all, expenses improve efficient cost management. We have net profit margin. So the formula is net profit divided to revenue times to 100. So the calculation is 65,000 divided to 250,000 times 100. So the result is 26%. So this shows strong profitability. After all, expenses improve efficient cost management. We have net profit margin. So the formula is net profit divided to revenue times to 100. So the calculation is 65,000 divided to 250,000 times 100. So the result is 26%. So this shows strong profitability. After all, expenses improve efficient cost management. We have net profit margin. So the formula is net profit divided to revenue times to 100. So the calculation is 65,000 divided to 250,000 times 100. So the result is 26%. So this shows strong profitability. After all, expenses improve efficient cost management. And then next we have liquidity ratio, which is the current ratio. So the formula is current asset divided to the current liabilities. So the current asset is cash 15,000 and the supplies is 5,000. So total current assets is 20,000 and the current liabilities is 20,000. So the current ratio is 20,000 divided 20,000 and we got 1.0. So it means that we can cover short-term obligation, but this limited liquidity increase cash flow risk. So for the solvency ratio, the debt ratio, and the formula is total liabilities divide total asset. So the 70,000 divide 140,000 and we got 50%. This indicates that half of our assets are debt finance, it representing the moderate financial leverage. For the debt to equity ratio, the formula is total debt divide total equity. So the total debt is 70,000 divide 70,000 and we got the 1.0. And this also reflects that equal mix of debt and equity financing, showing a moderate financial risk. So for the loan recommendation, we recommend that the 50,000 loan, but with caution. That is because the strong profit support expansion, but total liability will jump to the 120,000 ringgit, making cash flow management essential. So for buy now pay later, the implementing buy now pay later can boost sales volume, attract customers, and improve retention. However, it risks delay cash collection and bad debt. Its profit does not equal immediate cash flow. So for buy now recommendation, our final proceed with buy now pay later only if we enforce strict credit controls. So we must assess customer credit, set clear terms, and limit credit to safely manage cash flow risk.
Alright, now is for part B, tax accounting. So what is tax accounting? Tax accounting is a field of accounting that record, analyze, and also report tax related of transaction. They will ensure individual and business company with a tax law. They are focused on determining taxable income and also tax liability. Different from financial accounting, which is financial accounting will focus on business performance. Alright, now I will explain about principle of tax accounting. The first one is tax compliance. Tax compliance is following tax law and filing returns correctly on time. The second one is tax planning, to organizing finance to minimize tax legally. And then tax reporting, which is to calculate and reporting taxable income accurately. So the last one is record keeping, which is to maintain receipt, invoice, payroll, and also financial records.
Now I will talk about the importance of the tax accounting. The tax accounting helps business follow tax and law to avoid the penalties. It also helps companies to plan their money and make better business decisions. In addition, it improves the cash flow and it helps business to use their money correctly. Now, Let's look the difference between financial accounting and tax accounting. Financial accounting is used to prepare financial reports for investors and other users. Tax accounting is used to calculate taxes and follow tax law. So financial accounting is for business reporting, while the tax accounting is for paying the tax correctly. And there are also challenges. Tax accounting and tax laws can change often, and the tax rules can be difficult to understand. If there are mistakes, business may have to pay penalties. Also, international taxes and the accurate calculations can make accounting more challenging, and tax accounting also can be with several challenges. It's difficult for business to stay updated. Rules, deduction, exceptions can be complex. Even a small mistake may result to penalties or tax audit. Let's talk about accounting in Malaysia. It is managed by Inland Revenue Board. Malaysia uses a self-assessment system. This means taxpayers calculate and submit their owner tax. The government also gives tax incentives to support business and tax, and submitted online through the managing system. Today, most tax returns submitted online through the filing system. This system makes the process faster, easier, and more convenient for individuals and even for the business. It reduces paperwork and waste of the time. At the same time, taxes collected by the government are used to improve healthcare, roads, and public transportation. Therefore, tax accounting benefits not only business but also to the country, economy, and the society whole. To conclude, tax accounting plays an important role in every business. It ensures compliance and support financial access. Thank you for attention. Terima kasih.